Yeah, there's been a lot of action in uranium, actually over time, but certainly right now we're hearing a lot of activity around uranium and around nuclear, and it seems to be getting a lot more attention than it had. I see what somebody was saying about this sticking. Ding, ding, ding. Well, let's try that. There we go. Forward-looking statements. You can check that out on our website. I want to start out by talking a little bit about uranium in general, because it's a very, very different commodity. It operates in a very different fashion, and a lot of investors are having a lot of trouble putting their hands around what it is and how it moves, and how to relate things like the price of uranium to what's going on with the equities. So the first thing to keep in mind, and actually even before this, I'm going to mention that it's a very small market, and that's what makes it bounce around a lot. Actually, we had coffee earlier with head of marketing for BHP's uranium group. He sells all of the Olympic Dam uranium in the world and around the world, and that makes up 1% of their overall revenue. And Olympic Dam's the largest uranium mine in the world. So it's because it is such an efficient product, it is such an efficient commodity, it is a small market. So you're going to see it bounce around a lot. But it is very inelastic, and that is to say that once you've started up a reactor, you can't change your mind. You're going to be buying uranium for the next 40 years, and you can't replace it with something else. I think uranium makes up about, or the fuel makes up about 10 to 15% of the cost of generating electricity in a nuclear fashion, and the U3O8 itself only makes up about 25% of that. So uranium can double, triple, quadruple in price. It's still going to get bought. It's not going to slow down because the price is too high. The other thing is very opaque. There is no formal exchange, which means that we don't necessarily know what it's buying and selling for. There is no bid, there is no ask. Transactions are done directly between a producer and a utility that owns a reactor. And that makes it difficult for investors to understand what the price of uranium is on an ongoing basis. It's very illiquid. So on the spot market, which is just a small segment of the uranium market, you're going to get on average one trade a day. And some days it's 5, and some days it's 0. So it's very illiquid, and it will jump around a lot as a result of that. And it really does lack transparency, and I guess that's shown best in this slide. 15% of the uranium that is traded is done on the spot market. Now, the spot market is something that we do tend to see on a regular basis. Like I say, there's about 7 trades a week done on the spot. But that is not necessarily uranium that's going into a reactor. So it does not necessarily represent true demand for uranium. What it represents are traders buying and selling amongst themselves. It might be a producer who's picking up some to throw against a contract. It might be a utility who's just managing their ongoing inventory. It might be a fund like Spot Uranium Trust or Yellow Cake, who is actually buying it up in the market and putting it in a warehouse, never to be seen again. But that's essentially what that 15% represents. And because it's the most visible price, it's the price that people follow and hope to heck that that's what is driving the market. And in fact, it's not. The rest of it is all sold on long-term contracts. So once you turn on a reactor, you don't want to be running out of fuel. So these contracts will be bought, again, between a producer and between a utility over 3 years, 5-year delivery, 8-year delivery. They will buy these contracts. And the challenge with those is 60% of all that uranium is being done off market. So these contracts are not necessarily publicly available. We don't know what the heck it is that they're trading at, or what the terms of those contracts are. The 25% you see there is actually just maybe public RFPs and things that are in fact made public, but it just represents a small portion of that market. So it's a very difficult market to follow. Certainly a very difficult market to understand what is to equate the price of uranium to what we see going on in the equities, which makes it difficult for investors. What you see on the right, that is in blue, that's the spot price. So that's what it's doing over the last 3 years. Compared to what you see the orange dots are, that's the long-term price. So while the spot price has been jumping up and down like a mad person, the long-term price has been kind of ticking up gradually. But over the last year or so, it's really leveled off at that $80 point, and for about a year and a half. So the world would look at that and think, well, uranium is not really moving, it's not getting tighter. But the fact is the $80 price that you're looking at there is actually just the base price of a contract that contains numerous terms. There's floors, there's ceilings. It's tied to GDP, it's tied to production costs. There's all kinds of reasons why it's never actually sold at $80. It doesn't get delivered at $80. But there's other terms such as flexibility. 5 years ago, maybe 30% of my contract I could push forward. I could take that volume sooner. I could not take it at all. I could take more. But what we are seeing is that those contract terms are tightening and tightening. So it's the cues that we're looking for and listening to understand what the price of uranium truly is and when we're actually going to see this thing hockey stick. Because when uranium does start to move, it tends to move rather quickly because it's illiquid, because it's a small market, and because the world needs it if they're going to keep the lights on. Anyway, that's my point with regards to uranium, and we can talk about that all night long. This is us. We're definitely an exploration company. I want to make that clear. We do not have a resource that we're moving forward. We are an exploration company. But what we've, over the last certainly 10 years, we've been working out in northern Saskatchewan for about 20 years. We've developed and evolved into a bit of a system here. The Athabasca Basin is an area in northern Saskatchewan, Canada. This is where all of our uranium comes from. Primarily right now it comes out of two mines in this area here, which is the mine trend. And the uniqueness of this area is twofold. One is the grade. The two mines that are currently producing uranium in Canada, Cigar Lake and McArthur River, have average ore grades of 20%. You mine uranium around the world at about 0.4, 0.5%. So it is a bit of a freak show with regards to ore grade. And we've all seen it. We've all been pulling that kind of stuff out of the ground. The other thing about it is it's continuously prolific. And that is to say, over the last 30, 35 years, we're essentially finding a new deposit every 18 months. So, and they're not getting smaller and smaller, they're just getting different and bigger and different shapes and sizes. So we are continually finding new opportunities for uranium. And if you look at all the uranium exploration companies in the world, probably 90% of them are sitting here because this is where the opportunity truly is. What we've done over the last while that's helped us out, because we've been there for so long, is we've been able to identify and acquire properties across the basin. Everything you see there in orange is us. But in addition to that, all of these projects, most of these projects, are joint ventured with major producers. And that is to say, it is very expensive to operate in northern Saskatchewan. This exploration work we do is not cheap. Next year we'll probably spend $5 to $10 million in the ground looking for uranium. And typically juniors that are doing this eventually just dilute themselves into oblivion. What we've been able to do is identify and invest in projects of merit that we've been able to attract majors to now continue to invest alongside of us. So for instance, these projects over here, we joint venture with Cameco and Orano. We own 20 to 27% of those projects. So we have to come up with that money ourselves, our 27% or 21%. And, but we also operate those projects. So we earn a management fee for doing that as well. Our partners are continuously investing in those projects. And same with on the other side, we have projects that we joint venture with ISO Energy. And it provides us with a few benefits. Number one, certainly it starts paying the lion's share of the exploration that is required to find these types of deposits. Secondly, it validates these projects. Cameco, Orano, they cannot free up budget for exploration on a project that they don't think has the potential to produce 100 to 150 million pounds of uranium. So I don't have to stand up here and show you pretty pictures and tell you about my geology. They've already done that for us. Thirdly, we operate all of these projects, so that sort of validates our capabilities in the field. We are essentially the exploration arms of these companies. And finally, like I mentioned, we, as the operator of these projects, we earn a management fee that, for the most part, pays our overheads. So we've been able to create an exploration model here that is somewhat sustainable, where we can keep our dilution low, and demonstrate on an ongoing basis that these are in fact projects of merit, because we have some major players who are continuing to cut checks to move towards that. In the last year, I'll just run through these quickly. Smart Lake is a project. We own 27% of Smart Lake. Cameco owns the remainder. Hook Lake, which I'll go through, is we own 21% of that. Cameco and Orano each own 39.5%. This entire district up here is a joint venture we put together with ISO Energy. We own 50% of that, and again, we operate. Some of these projects down there, we hold 100%, and we're continuing to advance those, and so that we can eventually find partners to help us with those. So the work we did in this current year was drilling out here. We've done some drilling out at Tabernor, and certainly some drilling up at Dorado, which I'll talk to. That's where we hit some pretty spectacular assays this past season. We have outstanding shares of about 79 million shares. We did a consolidation of our shares. We've been around for a long time, but we consolidated those shares last year. In order to maintain the price on those shares, we did it in conjunction with our transaction with ISO Energy. We did a major raise at that point in time. We brought on some significant players in terms of not just ISO, Mega Uranium, Satcham Cove, Tribeca. If you know any of these names, these are major uranium funds. And we currently have a market cap of just over, that's not correct, but it's just over $50 million right now. Things have happened since September. I'm going to start with this one. This is the projects that we put together late last year with ISO Energy. So now ISO Energy is more of a development company. They own projects in Canada and the United States and Australia. They, a couple of years ago, put together a resource up here known as the Hurricane Deposit. It's about 50 million pounds at an average ore grade of 45%, which is, again, quite nuts. It is the highest grade uranium deposit on the planet right now. We each had a number of projects in this area. We decided one of the best ways to get them advanced was to put them together. So we collectively put all of those projects into a bucket, put together about 100,000 hectare district in the northern end of the mining trend, and those are our projects. We divvied them up into three just so we could deal with them specifically, and we're operating those projects now. We started last season, or this last summer, drilling at Dorado. So this is ISO Energy's Hurricane Deposit here. Again, we're dealing at the northern end of this mine trend. There has been uranium identified throughout the entire area, but this corridor here, this Laroque corridor, is what hosts this particular deposit. Cameco has one to the south of it, about 8 kilometers, that's been hitting 30% uranium. Down here at Orano's Alligator showing we've got 10%. Denison to the north. So as this trend came up to the north, it tends to now wrap around through this area and across the top. And by putting all of these projects together, it gave us a lot more elbow room to really start to look at and understand the geology of the area and where we thought we were going to find a lot more uranium. We were able to incorporate all of the geophysics, all of the past drilling, and we moved forward this summer by picking those areas that really had never been followed up properly on, and we retargeted everything. Through that process, we identified on our second area, this down here, this Nova discovery. We drilled 4 holes down there, and we started hitting uranium in the area of 2 to 5 to 8% uranium, which is, again, unheard of. So it's a fairly large area down here. You're looking at about 4 kilometers. Each of these areas here is about 400 meters apart. And, all right, no, they're 800 meters apart. You can fit, typically, because of the grade of these things, you're typically fitting a deposit in an area smaller than a football field. So they're small, they're pod-like, they're easily missed. Some drilling was done to the south, some drilling was done to the north. We identified the structure and indicators that we like to see. We drilled this summer in the center point there. We drilled 4 holes, and again, we came up with some pretty high-end numbers. So we went to chase that to the north. There's a swamp to the north. We cannot plant a drill in the middle of our swamp. So we'll be going up in January again. Most of the work done in northern Saskatchewan, we like to do it in the winter when everything's frozen because it's fairly flat, it's wet. There's a lot of lakes, there's a lot of streams and things, but when it's all frozen, we can drag drills around. In the summer, like this work we were doing, it was with a helicopter, which tends to double the price of drilling up there. So we will be going back to this area in January to carry on. We have a $6 million budget on the IsoEnergy joint venture projects this coming year. Most of that will be spent following up on this and seeing if we can turn this into something even more spectacular.
3 minutes left.
3 minutes. Oh my gosh. All right, we'll hit this one quick then. This is Hook Lake. This is our joint venture with Cameco and Orano. It is one of their most important projects right now, exploration projects on the western side of the basin. It sits adjacent to, if you've heard of these folks, NextGen has their Arrow deposit to the south at a little over 250 million pounds of uranium. Paladin down here, which recently bought Fission, their Triple R deposit is at 114 million pounds of uranium. We have a smaller deposit to the north called Spitfire, but it's too small for our folks, so we keep moving on. And this is a fairly large area that we've been working on for a number of years on the exploration side. Again, running ahead of all the work we've done to date, there's 2 areas right now that are our primary projects, or areas that Cameco has seen as a priority. One is up here, this lightning zone. We've been working up that conductor there, and where you see the star, that was our last hole of the last drill program, where we start again to come into high-grade mineralization. The other thing that we're keeping an eye on is NextGen's Arrow deposit here. They've just started drilling to the east of that. They just finished a 40,000 meter drill program, and it looks like they're drilling off yet another pretty significant deposit there. Based on the numbers we've seen so far, we think they're looking at about 40 to 50 million pounds already at about 2 to 3% average ore grade, which is important to us because this is Arrow, this is our Spitfire deposit here, this is where they're now drilling, and we've got an entire area to the north that it trends onto that we have not touched yet. So Cameco and Orano are certainly looking at that as a priority for us moving forward. Smart Lake, we did some drilling this last year, and Cameco is keen to get back up there. And we have a number of other projects that we own 100%. All of these are in a pipeline that we are advancing, continuing to advance, and I think I'm probably running out of time. So there you go. One thing I will mention is we do put out a lot of information on the uranium industry in general, because again, it is fairly complicated to a lot of people, and it's hard from an investment standpoint to understand what you're looking at. Things aren't reacting the way you would expect. We ourselves have a handbook that you can get online that incorporates all of our projects in great depth, but also has a lot of information on northern Saskatchewan, on the basin, all the players up there. We have a monthly newsletter that talks about all uranium exploration on the planet right now that we put out. We have a white paper that talks about the timing of when we see the next uranium spike happening in terms of pricing. And we have a weekly podcast every Tuesday morning, 10 minutes, quick 10 minutes, that brings you up to date on the market on uranium, on what's trading and what's been happening in the area. And if you talk to young Janie in the back, she can certainly hook you up with all of that good stuff, or our good friends here at Proactive. But there you go.
Well done. And that podcast is excellent. It's excellent. So I've harvested a question from one of the more recent podcasts you've done, which is...
Now I got to remember it.
Current prices for uranium, are they being viewed as the floor and not the ceiling?
The floor and the ceiling. No, actually what they're being seen as right now is the price at which... The problem we've had historically is that after Fukushima, after Japan turned off 10% of the world's reactors, we saw uranium prices drop down to about $25 a pound. You cannot produce uranium at that price. We saw mines shut down. We saw them slow down. The incentive price of turning those things back on was always said to be about $70, $80 a pound, which is where it is right now. So you see the floor price of long-term at 80. You see the spot price jumping up and down around the $80
so Chris,
mark.
Is it the ceiling or the floor?
It's not. It's neither. Right. So right now it's the floor. Right now it's the floor. If that's where you want me to end up with. But again, the problem with uranium prices is that it's not the real price that uranium is moving at. So.
Got it. Very quickly, because other people want to ask you questions.
Okay.
So there's upside potential. Here we go.
Thank you. With Rolls-Royce building SMR, and Hungary and UK has already building the factory.
Yes.
Are you working in collaboration with those two countries or Rolls-Royce especially to market your product?
Right. So no. Quick answer, no. There is a lot of anticipation around SMRs. Certainly in Ontario, where we're from, we're going to have a few plugged into the grid by the end of the decade. But from our perspective, SMRs, even the AI stuff and the data centers, are a bit of a red herring. We're seeing demand going up in the future, but the problem we have right now is that we don't have enough uranium to fuel what we currently have. And SMRs, you need about 10 to 20 SMRs to consume the same amount of uranium as a typical reactor. So you're going to need a lot of SMRs before they're going to affect what's going on in our market, the fuel market, in the near term. If that's helpful.
Anybody else? Yep.
What's the impact?
Wait. I need you to use the microphone.
Forgive my naivety, but Russia, as a producer of uranium, what's the impact of sanctions and potentially those?
It's big and not necessarily in an obvious way. So Russia produces about 12% of the world's uranium. The United States, which hosts about 25% of the world's nuclear fleet, buys half of the uranium from Russia, Uzbekistan, and Kazakhstan. So that's a problem. The other part of that problem, though, is that Russia has been doing the conversion of uranium into fuel to the extent of about 40%. So countries around the world will send their U3O8 to Russia to go through the process of conversion, fabrication, enrichment, and comes out the other end. So the problem that the world has had is that Russia, all of a sudden, we can't get that uranium back from them. And so although it's only 12% of the U3O8 they're producing, it's actually 40% of the fuel that they're responsible for. So we're seeing a couple of things. We're seeing some bifurcation in the market. That is, we're probably going to start seeing two prices for uranium, because Kazakhstan, which produces 40% of the world's uranium, has now contracted most of that to Russia and China. The United States, which needs all this stuff, can't necessarily get it anymore. You've got countries like Niger, which is probably the third or fourth largest producer in the world, went under a military coup, and they were producing 25% of Europe's nuclear fuel. So you've got all these things happening where the Western world, which requires fuel, is now getting cut out of a lot of the major sources of it. So they're responsible. Well, they're now having to look to Australia and Canada for their fuel, and we're seeing a lot of new fabrication facilities being built in North America and in the western part of the world to replace what got cut off from Russia. So it's been a bit of brick in the head. Yeah.
So, Chris, so much knowledge, but so little time for us to extract it
always,
out of you.
always.
Thank you very much indeed. Really
Thank you.
appreciate it. Thank you, Jeannie, as well.